You're listening to international investment advisor Doug Goldstein on the Goldstein on Gelt show, the financial show where we'll talk about how you can make the most of your money. With all the confusing financial chatter bombarding you each and every day, Goldstein on Gelt will give you the practical information you want and need about living a financially stable life. Here's your host, money maven Doug Goldstein.
Okay, we are back. I'm very happy to have on the Goldstein on Gelt show Anat Admati, who's a professor of finance and economics at Stanford University, and she just came out with a new book called The Banker's New Clothes: What's Wrong with Banking and What to Do About It. Anat, a pleasure to have you.
Thanks for having me.
So first of all, congratulations on the book, and could you tell us, who's it for?
Well, the book is written for everybody because we realized at some point that talking just to the banking experts and to those involved is not going to get us far enough, and we need to get a few more people involved in this debate to kind of get those involved to pay more attention to what they need to do about this system.
So for those people who are not yet involved in the debate, what are the key issues that people are arguing over?
Well, the question is how to make the banking system kind of work for the economy so that it's healthy and doesn't create too much danger for other people, the rest of us.
So the danger you're referring to is what we saw 6 years ago?
Yes, actually, it's a little bit beyond that. If you have a crisis, obviously, we're still living the consequences of that crisis. Europe might yet implode. Its banking system is very unhealthy, as is, of course, its entire system, really, of Euro. But beyond that, we're still licking the wounds from the previous ones, both in the banking system and in the rest of the economy, in terms of recovering from a crisis that was greatly caused by this fragile system. And the question is the system better now? And the answer is actually no. Very little is done.
You don't feel that banks are being more cautious about how they lend and not letting people borrow so much money to buy a property?
Well, actually, lending is only a part of what the banks do, and it is a part that they can take risk in, but they take lots of other risks, and they're very highly interconnected. So the whole system is a very fragile system. That's the problem. And the thing is that there is something to do about it, and the frustrating thing is that not much actually is done to create this a better system. The other thing is that banks don't always make the right kind of loans. They might make too few or too many. So it's just they're not healthy corporations as corporations. That's basically our main point.
Do you feel that there's a lot of transparency? So when someone puts his money into the bank, he knows what's actually going on behind the glass doors?
It depends how you put your money in the bank. If you put the money in the bank as deposits, then usually you're insured in most countries. And that's part of the problem, is depositors don't really care. But then the question is, who does care about the risks that the bank take, or, as we emphasize, about how much borrowing overall they do, which is a lot.
So if the banks are borrowing, like any business might borrow, they'll either make it or break it. Lots of companies go out of business because they're over-leveraged, and then they go bust. But that's a problem for the investors, whereas the depositors in the bank, as you pointed out, are insured. No one lost any money as a result of the banking crisis if he simply had bank deposits and CDs, right?
Much more than that. Actually, nobody lost money who had the bank promise them anything. Even if they were supposed to be absorbing losses, they were kind of called capital, and the regulators thought that they would participate in losses. The banks just want to make a lot of promises, and then somehow, when they run into trouble, then somehow those who they made promises to are still paid. The only people who lost were shareholders of the bank, but that's who should lose, because the shareholders make the money. Actually, the people who won the most are the bankers themselves. They did a lot better than the shareholders because the shareholders lost on the rest of their portfolio and as part of the economy.
So explain to me the problem then. If the shareholders lost, and as you say, they deserve to lose because they were the owners. I don't wish anyone harm, but if they owned the company and it was making bad investments, they lost, and the depositors were okay. And I think it's a little bit greedy that the bankers themselves made out like bandits. But what exactly is the problem you're defining?
The problem is the collateral damage of their defaults. The problem is they needed bailouts in order not to harm even worse. And the problem is that if this happens again and they run into trouble paying their own debts, then they harm other people and they harm the economy and they get credit crunches and all these problems. That is why they end up being bailed out. So the issue is, can they be a healthier corporation? And here is the problem. There is no healthy corporation or healthy industry that is so indebted as the banks. And nobody could become as indebted as the banks if they didn't have so much safety net, if their creditors wouldn't agree.
Is that because the government's always there to back them up?
Pretty much. The depositors really don't care. And in fact, even beyond deposit limits, the government ended up paying. Money markets ended up being guaranteed. And especially for the large banks, somehow it gets paid. And even for the smaller banks, when the industry tends to fail at the same time, then somehow the creditors are not as worried as creditors would have been with the same kind of balance sheets elsewhere.
So it almost sounds as if because the government was there to bail out the banks were completely free to take whatever risks they wanted, knowing that it really wouldn't hurt them in the end, which would suggest, therefore, that the government should make a policy, not retroactively, but going forward, that maybe they wouldn't bail out the banks in such a situation, and that would force the reform.
Well, here is the dilemma. The dilemma is that there's a bad choices at a situation. In other words, if you get there, your choices are to bail out or huge damage. Look, they let Lehman Brothers fail, and it triggered a huge contagion and problems. So now you have banks that are multiple times bigger than Lehman. Will they be allowed to fail? The government seems to be afraid of a Lehman moment. And there's your problem. So the question is, are we stuck? Is it like an earthquake? We just have to sit back and, put ambulances by the road, create resolution mechanisms, all of that? Or can we prevent these, what is it, a financial crisis? And here is the good news. The good news is you can actually prevent a lot of it. And the problem is that you just have to sort of counter their incentives to take all this risk, and the fact that the safety net that was created through deposit insurance and through these sort of implicit guarantees that just people believe are there is precisely, as you said, enabled more risk to be taken. It's kind of paradoxical.
Mm-hmm. We are talking with Professor Anat Admati, who recently came out with a new book called The Banker's New Clothes, What's Wrong with Banking and What to Do About It. She actually she got her undergraduate degree in Israel at the Hebrew University, and her PhD came from Yale. She's been explaining to us what the problems we've seen in the banking sector have been, and you mentioned, Anat, that there might be a way to prevent it. So what's your proposal for preventing these problems in the future?
Well, you have to go to the heart of the problem, is what we say, and the heart of the problem really is that borrowing in general tends to have a sort of addictive properties. In other words, a heavy borrower tends to be biased in favor of more borrowing as they fund. And for the banks, that becomes really difficult because they're unable to borrow more. So the solution is first and foremost to make them a lot less indebted. So we're talking about what's called capital requirements. Sometimes it's misunderstood that that's what these requirements are about. They're not about reserve. They're about the funding of the banks and the level of borrowing relative to other funding that they do. And our solution is immediately to strengthen them by having them fund with much more equity so that there is more loss absorption. It's like increasing the liability of an owner, basically.
That'll make them less profitable, meaning they will have less money that they're able to lend out, but that'll also make them with a stronger balance sheet?
Well, it would prevent them. The only reason that this would make them less profitable is because they will be able to enjoy less of subsidies that are basically given to them only when they borrow. So if you remove a subsidy from somebody who pollutes, that's not a cost to society because they might save $2 million and you cost you $20 million to clean up after them. Mm-hmm. So it doesn't make any sense. We're subsidizing something that's harmful. We're subsidizing their borrowing as opposed to their healthy funding.
So you're against the subsidizing the banks. Is that correct?
Well, I'm against, yes, because that gives them a funding advantage, which also gives them perverse incentives to grow and take advantage of the subsidy because it's a kind of subsidy that they can make bigger.
But should the government Should the government ultimately be there to backstop the banks if they go through such a traumatic experience again?
We're not judging the bailouts. The government should do what's best in a given situation. We are trying to put this banking system much more on its own feet, so it's a little more normalized, and therefore it cares about the downside as much as it is crazy about the upside of their bets.
Mm-hmm. Do you think the banks are simply following what the lessons they're learning from the government, which it would appear to be out-of-hand borrowing as well?
Well, the bankers are responding to their own incentives. We complain as well about systems of risk weights and others that distort the bank's decisions in terms of, in particular, biasing them even against boring business lending and into other things that the regulators might view as less risky, but they actually are risky because they chase returns and therefore take risk. The problem is they harm other people. So we need to get them to just be more, it's a private corporation, they have other funding. Government's borrowing is a little bit different, but in fact, part of the bank's problems is they lend to governments sometimes too much. Mm-hmm. Greece borrowed as much, or even home borrowers borrow as much because the banks lend them.
Mm-hmm. And is this the solution to this? Is this a regulatory solution, meaning the government should just change the way the rules are done, or is this something you would hope that the market would force the banks to do by saying we're not going to do business with unstable banks?
No, this has got to be by regulation. There is no way this is going to self-correct because incentives are not there. There's basically a fundamental conflict between what's good for the banks and if you think about them as being owned by one person or the people who are most concentrated in the banks and sort of the overall public. It's a polluting situation. Think of a car driving fast and the competition between them says you want to drive faster, otherwise you don't survive. Mm-hmm. I'm talking about speed limits.
I understand. All right. Well, it's certainly a very, very important discussion that we're having. We're talking with Professor Anat Admati, who just came out with a book that's designed to be read by everyone, not just for people who are in the banking world. It's called The Banker's New Clothes. Anat, we're just about out of time, but tell me in the last few seconds, how can people follow your work?
Well, we have a website for the book called bankersnewclothes.com. If you search Admati or Admati et al. On Google, you will find the writings from the last 2.5 years, even a calculist story from a couple of years ago, a year and a half ago. And that's where a lot of the action is right now. The book just came out, and it should be available in Israel also in English at this point. And I hope people read it.
Okay. Professor Anat Admati, thank you so much for your time.
You've been listening to the Goldstein on Gelt show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt show.